The Strait of Hormuz is closed. It's a profound disruption that instantly rewrites the rules of global trade and literally paralyzes a massive fraction of our energy infrastructure. 10 million barrels of oil have vanished from the global supply. Poof, gone. And we're also looking at 20% of the world's liquefied natural gas evaporating from the market overnight. The arteries of international commerce are basically suffering a massive heart attack right now, and entire national economies are bracing for immediate impact.
And yet, despite a physical reality that points straight to immediate rationing and crippling global inflation, the S&P 500 is blindly targeting 8,000. You are living in a two-standard deviation economic bubble, and the margin for error is officially zero.
Okay, let me explain exactly why this is happening. Let's dive into the timeline here, because the speed of this fracture is just staggering. Following the February 28th strikes, Iran effectively blocked the strait. They completely severed a maritime choke point that is responsible for a fifth of all global oil. Within days, we saw force majeure declarations and insurance cancellations rolling in.
Now, before we look at exactly how the markets are responding, I need to remind you, this briefing is for strategic intelligence purposes only. This is not financial advice. All investments carry significant risk, particularly in a fragmented geopolitical environment driven by algorithmic trading. All right? Welcome to the most severe global supply chain and economic disruption of modern history.
Look at this contrast. It brilliantly illustrates the great divergence of 2026. On one hand, we've got a physical economy forced into total chaos. Over 150 ships are stranded right now. Major carriers are rerouting all the way around the Cape of Good Hope, which adds a grueling 10 to 14 days to transit times and sends Jebel Ali port into massive congestion. But then, look at the financial economy. It's wildly juxtaposed against this physical reality. The S&P 500 is up 5% this year, driven almost entirely by the Magnificent Seven and the sheer, unadulterated excitement surrounding Anthropic's new Mythos AI model. The algorithms are quite literally ignoring the physical world in favor of digital promises. So how is this even possible?
Well, the answer actually lies in the fracturing of global monetary policy. Major central banks are suddenly operating on entirely different planets. The European Central Bank and the Bank of England, they're battling a deepening stagflationary siege. Europe is facing a severe energy shock directly from the Hormuz closure, and the BOE is dealing with the highest gilt yields we've seen in nearly 2 decades. But the Federal Reserve? They are attempting an active hold. They're desperately trying to balance a massive $700 billion AI infrastructure boom against surging geopolitical inflation.
The Fed has kept rates totally frozen at 3.50 to 3.75%. They are playing a very dangerous game of chicken with global markets right now. And hey, following the reveal of the Fed's stealth QE and these frozen rate cuts, if you want to survive the greatest capital reallocation of the decade, hit subscribe right now. We track the raw data that the institutional algorithms try to hide. So the absolutely crucial point here is exactly how the Fed is sustaining this 8,000-point index bubble. They're quietly deploying what we call stealth quantitative easing. Instead of aggressively shrinking their balance sheet to fight the inflation from Hormuz, they're funneling the proceeds of maturing bonds right back into short-term T-bills. Let me put that in plain English. They are taking old debt that just got paid off and immediately pumping that cash right back into the system through short-term loans. This injects massive shadow liquidity into the banking system, artificially propping up equities and shielding those tech stocks from the very real geopolitical risks exploding in the Middle East. But here's the catch. This artificial liquidity isn't lifting all boats equally. It's actually building a massive, undeniable divide in commercial real estate. On one side, we have traditional, secondary Class B office spaces facing devastating vacancy rates, massive devaluation, and a looming refinancing cliff. It's ugly out there for them. But on the exact opposite side, we're seeing the explosive vertical growth of industrial logistics and AI data centers. These specific assets are experiencing completely insatiable demand because, well, they are the actual physical backbone of this digital boom. And this growth isn't about traditional locations or your standard real estate metrics anymore. It's entirely dictated by two massive macro forces. First up is economic nationalism, which is driving a rapid push to nearshore critical manufacturing away from China. The second force, the staggering power requirements of AI data centers. AI server racks run incredibly hot and need immense cooling and electricity. In fact, sheer power availability is now the ultimate undisputed site selection metric. Proximity to major cities literally doesn't matter if you can't plug in. If you have the power grid to fuel the AI future, you win.
But here's the thing. The foundational layer of all that technological growth requires hard assets.
As the world pushes for electrification and this massive AI expansion, silver has entered a structural bull market. What you're seeing is silver's sixth consecutive year of deficit. The demand is just wildly outpacing what miners can pull out of the ground. For 2026 alone, we are projecting a massive shortfall of 67 million ounces. And I want to be incredibly clear about this. We are not talking about people buying jewelry or fancy silverware here. This is critical, inelastic, industrial consumption. Silver's superior conductivity makes it absolutely vital for solar panels. Demand in that sector alone has skyrocketed from 80 million ounces just a few years ago to over 200 million today. Furthermore, the advanced electronics, semiconductors, and components that make AI hyperscalers function literally cannot operate without it. A single AI server rack uses exponentially more silver than a standard legacy rack. This hardcore industrial necessity is causing the gold-to-silver ratio to tighten to levels we haven't seen in 15 years.
This severe structural deficit is exactly why major institutions, like JP Morgan, see silver prices averaging an astonishing $81 per ounce in 2026. That is up well over 130% from early 2025. So what does that actually mean for us? It represents a historic shift in capital. We're moving away from purely speculative digital assets and directing capital straight into physical reality and heavily constrained commodities.
Which brings us to the ultimate question you need to be asking yourself right now. With the Strait of Hormuz choking the physical economy and algorithmic shadow liquidity inflating the stock market, who actually wins? The real generational play isn't AI software. It's the electric stack, hardware, the silver supply chain, and the concrete holding the data centers. That's the secret to 2026. Binge our Alternative Asset Matrix playlist next to see exactly which logistics reads are positioned to absorb this capital. The physical world is violently reasserting its dominance over the digital. The only question is, are you positioned for it?